Hello and welcome to the CEO Sentimeter. I'm Shireen Bhan. Domestic air traffic continues to improve, rising 67% year-on-year in October to 88 lakh passengers. This has meant good news for India's biggest airline, IndiGo, which has seen its losses narrow in Q2. But high ATF prices and uncertainty over full resumption of international travel continue to be headwinds for the aviation sector. To discuss the flight path for the airline, we're now joined by Ronojoy Dutta, whole-time director and chief executive officer at IndiGo. Rono, always a pleasure. Many thanks for joining us here on CNBC-TV18. As I pointed out, for the fourth straight month, we have seen an improvement as far as domestic passenger traffic is concerned. We've also seen an improvement as far as your losses are concerned, narrowing in Q2. In that investor call that you did post your earnings, you talked about how this is the time to heal after the damage. Is it going to be a slow recovery, a slow healing process? What's the kind of cash burn that you're now seeing every day?
So things are improving and improving rapidly, I would say. We went, as you know, the government allowed 100% capacity, and we've gone to about 95% and heading towards 100%. Equally important, though, the forward bookings, the revenue numbers look very strong. So if I were to just look at domestic, I'd say, hey, COVID is kind of over. You know, we're coming out of it. Internationally, it's still a bit of a challenge. We had about 65% revenue bookings compared to pre-COVID. But the good news there also is that the governments are gradually doing this bubble arrangement country after country. We are now most hopeful that the next target countries will be Saudi Arabia, Nepal, and Thailand. And if those markets also opened up, that'd be great. So how quickly do we get back? You talked about repair and healing. Our balance sheet really took a battering, as you know, over the COVID period. And now we'd like to repair that balance sheet. So yes, we're still burning cash, but we have a sort of slight glimpse that profitability may not be too far off. For now, it's still not close enough, but we see the light at the end of the tunnel. So we'd like to get back to profitability and a positive cash flow.
By when? You said that, you know, it's still uncertain in terms of when you intend to be able to get to break even as well as profitability. Given the demand outlook and the visibility that you currently have, as well as where costs are, you know, what are we talking about? Is it likely to be stretched out over the next few quarters? What's your expectation?
So, you know, they say about forecasting. I forecast the level or the time, but not both. So I'm forecasting the level. Yes, we're getting back to profitability. Time, I will not hazard a guess. But all I can say is it's no longer a fantasy. It's something real that should come up reasonably soon.
Okay. You talked about an improvement as far as your cash burn is concerned. The last time you and I spoke, which was a few months ago, you were burning about 20 crores a day. What's the number currently?
We only announced that at every earnings call, I'm afraid. So we'll give that number at the next earnings call, but it's obviously going down as we speak.
Okay. You said that revenue is looking strong. What is the current expectation in terms of a pickup as far as the business travel segment is concerned, which has also seen a recovery? You know, if you can take me through some of the color on the demand side that you're witnessing today.
Yeah. Corporate travel is a good news story. As you know, it went down pretty sharply during the COVID. Then pre-Diwali, we saw some improvement. And in talking to the various corporate houses, they were all saying, listen, after Diwali, we're going to start traveling. And we're seeing that already. It's just a short period, I understand, just 3-4 days. But there's been a significant pickup in corporate travel. As a result, you will recall that we sort of withdrew some of our flights metro to metro and put them into tier 2, tier 3. And now we are growing metro to metro as well. So corporate travel is also coming back.
I want to understand from you, Rono, where things currently stand as far as fares are concerned, because we are seeing pressures specifically on ATF. While the government has announced a reduction in excise duty on fuel, we haven't seen that extend to ATF. Of course, missives have been sent out to state governments to do so on ATF VAT, but very few states have actually bitten that bullet. So where do things currently stand as far as prices, costs are concerned, and what will that mean in terms of fares?
So let me take a step back and talk about overall taxes for a minute. We are a very highly taxed industry. When it comes to indirect taxes, There's a 5% charge on all passenger revenue. On top of that, there's 11% excise tax on fuel. Then the states have their own taxes. And then for repair parts that go in and out of the country, we have to pay tax on that. All in all, our indirect taxes are almost 21% of our revenue. And that's obviously a very high number. So we've been talking to the government about trying to reduce this. And yes, some small progress has been made. A few states, and I recall Uttarakhand, Kashmir, Andaman, for example, they have reduced VAT down to 1%. But the bigger states, the Delhi, the Mumbai, the Karnataka, where all the volume is, frankly, in terms of fuel uplift, we have not seen much of a reduction. Therefore, costs continue to be a problem. I really feel the government should help the industry by reducing indirect taxes. And we struggle through, but it's going to be a hard grind for us, even when things get back to normal, if we are taxed at this high rate.
You said that costs continue to be a problem, and of course, you can't do much as far as taxes are concerned, Rono. But in terms of your own efforts, in terms of your own measures to try and bring down costs, and that's been a process that you've been, you've been on for the last several months now since the start of the pandemic. Where do things currently stand on that front? Is there room for you to do more, or are you starting to wind some of that stuff back?
So one of the strongest points in IndiGo's profitability performance is how our fuel consumption continues to go down. As you know, we have much more fuel-efficient engines, and NEOs are now almost like 50% of our fleet. And as that happens, more and more our fuel consumption goes down, and that, therefore, is a reduction in cost that we are happy with. As far as employees are concerned, we are seeing higher productivity and pushing for more higher productivity, but we're gradually unwinding the leave without pay and so forth. By December, we'll no longer have any leave without pay. We'll be drawing that completely. So employee costs are still under control, mostly because of higher productivity, but gradually, of course, we'll have to roll back the salary cuts and so forth. In all other areas, we made a significant push in network costs, on IT costs. So overall, our cost performance has been pretty decent, I would say.
Okay. Let me talk to you about the competitive landscape. And the expectation is that sometime next year we will see perhaps a combined might of AirAsia and Air India Express now that the Tatas have bagged Air India. That offering in the market, the Rakesh Jhunjhunwala-backed Akasa likely to take off as well. How do you see the competitive landscape changing next year, and what will that mean as far as your own strategy is concerned?
Clearly, more competition is coming. But I would say I'm really happy that the Air India disinvestment took place. I think it's good for the country. I think it's good for aviation. And I think it's good for IndiGo as well. So having a healthy competitor based on underlying economics is a good thing. And therefore, we're very happy that this is happening. I also think, is there room for a full-service carrier in India? Of course there is. So the Vistara Air India merger should find good turf to operate on. As far as Akasa is concerned, the playing field is actually more crowded at the other end, meaning in the low-cost carrier end. And Akasa will be flying smack into Go First, SpiceJet, and IndiGo in the LCC space. So they'll have a challenge there, I would imagine.
So it's likely to be more challenging for Akasa as it gets into the LCC space. But, just in terms of network strategy, in terms of fleet expansion, given where you see things currently, what's the plan? What's the outlook going forward?
The outlook going forward is back to rapid expansion. So we had a significant pause over 2 years with COVID and all of that. As we come out of it, we are ready to go. And domestically, we are already at 95% of pre-COVID. We'll probably go higher soon. And then the next big challenge, of course, is to get into international as fast as we can. But for that, the international markets need to open up. However, I have to tell you, the international markets are performing well. I mean, if you look at the loads in and out of India, they're good. The yields are good. So when things open up, I'm very optimistic that we'll be going with added capacity into the right market.
Any plans? You said that there was a pause as far as expansion was concerned, obviously on account of the pandemic, but does that also now mean that you are going to review where things currently stand on fleet expansion?
No, no. Our fleet expansion, as you know, we've got this big 350 aircraft order coming up for delivery, and it's on track. And as we speak, we're actually short of airplanes. So, we are hungry for growth and more capacity as fast as we can add it.
So are you likely to place fresh orders, or are you good with the order that's already in place, which will now start to show up for you?
Yeah, a 350 plane order, I think, is plenty for our planes. I think that's a good sized order.
Where do things stand as far as your fundraise plans are concerned? Because the board approval had come in for the same. You talked about being in a process of repairing the balance sheet as well. So where do things stand on the fundraise?
So the QIP, I think that's what you're referring to. A year ago, there was a lot of talk of a third wave. And of course, if there's a third wave, there's a question of will we go into another capacity lockdown? And QIP, as you know, is a long lead time item. And so we wanted to get everything ready and in place just in case there was a wave 3. Fortunately, that has not happened. So QIP is sitting on a shelf. And it was always meant as a sort of disaster insurance. And fortunately, we don't have to pull that line of credit.
Okay, so that's not going to be something that you exercise anytime now?
Correct. Not in the near future, but it's, we have the shareholder approval all the way through July. So we're just waiting and seeing. And if you ask me right now, is there any likelihood that you're going to do a QIP in the near term? I would say no.
Okay. All right. Let me ask you about where things stand. And I know materially you've always maintained that it doesn't impact the airline or its operations. But, the promoters and the arbitration process, the way that it's played out, and now it's moved to courts here in India. Can you take us through what the implications are likely to be, if any, as far as the airline is concerned?
Airline is concerned, again, zero impact. As you know, there's been no claim on the airline at all. So there was an arbitration award, and in the award that can be challenged actually for about a period of 90 days. And so until that 90 days expires, no action. After that, we'll wait to hear from either promoter group what they want to do next. But again, there's no implication on the airline. There's no claim on us. It doesn't impact us at all.
Okay. You talked about, getting back to rapid expansion, at least as far as the domestic network is concerned. What is that going to mean over the next few months?
We've really gone into small towns in a big way. And if you look at the Northeast, we've really connected the Northeast so well. Shillong to Dibrugarh, Shillong to Silchar, Dimapur to Delhi. And, we get all these appreciation letters from our customers. Oh, we've been waiting for this flight for so long, and thank you for integrating India. And that makes us feel very good, really. So we are trying to get to all the corners of the country and make sure that we always talk of our network as being the catalyst for economic growth. And we really are building that infrastructure very well. And fortunately, as we are building that infrastructure, the revenue is coming with it. So we are very enthused by the response we're getting in the marketplace. We intend to do more of that. And really, I look at every day at, okay, here are the new connectivity that we provided. And we just put something out in the press, I think, a day ago. We said, okay, now, Ranchi to Cochin, you can go through flight. It's a one-stop, but it's a good connecting flight. And Dimapur to Coimbatore and places like that. So we really are connecting the country so well, and I'm very happy about that. I like to do that internationally too, by the way. I see so much opportunities in the region around us. But domestically, we'll continue to grow. We'll continue to go into smaller cities. And fortunately, as I said, the metro-to-metro demand is also coming back. So if today I had more planes, I'd feel better. But I don't. We are maxed out.
Ronojoy Dutta, always a pleasure. Many thanks for joining us here to take us through where things currently stand and, more importantly, what the road ahead looks like. Appreciate your time here on CNBC-TV18. Well, we will take a break here on the CEO Sentimeter, but don't go anywhere. We're back with a lot more. The markets, of course, continue to trade about 230 points lower on the Sensex. That and more when we return. Hello and welcome to the CEO Sentimeter. I'm Shireen Bhan. Realty stocks have been on a tear lately as companies have seen huge demand for homes in the run-up to the festive season. Realty major DLF has seen its highest sales in the super luxury segment in Q2 of FY22, while also recording the highest collections and cash flow in the last 5 years as COVID pressures ease. The real estate sector has seen 3 downturns, but is this real estate revival now sustainable? To talk about this and more, we're now joined exclusively by Ashok Tyagi, the CEO and whole-time director at DLF. Mr. Tyagi, many thanks for joining us here on CNBC-TV18. As I pointed out, it's been a long winter for the real estate sector, but things have been looking better for the last several months now. I'm just taking a look at some data for Mumbai, for instance. 10-year high in terms of sales for the month of October. Even the first week of November has registered very strong sales. What's the situation like across the NCR region? Is the momentum that you saw in Q2 holding? Is it getting better? Is it easing?
So, good morning, Shireen. It's a pleasure to be here. So, honestly, I think ever since the ending of the first lockdown, which is really October last year, the sales cycle has bounced back and has honestly come back very strongly across the board. For the first quarter or so, frankly, a lot of us, including industry folks like us, were willing to write it off as a pent-up demand, etc. But honestly, it's sustained and strengthened. It's no longer just on the lower end of the economy end of the product segment. It's moved to luxury. It's moved to super luxury. It's moved across the geographies that we operate in. So not only just in Gurgaon, which obviously has seen a very buoyant sales, even geographies like Indore and Lucknow and Chandigarh, where we had slow-moving inventory for a long time. That inventory has begun, moving extremely well. It's found new legs. So I think it's been a far more widespread recovery than honestly, frankly, was looking the case not only during the pandemic, but even before the pandemic.
Okay, so widespread recovery underway, and you believe that the momentum is gathering further speed. But let me talk about one of the headwinds, and that has to do with raw material escalation in costs. And it has been fairly significant, whether you look at steel, cement, etc. What's the impact on the business so far, and what's the outlook from here on?
Okay. So, we've had 2 segments of products that we are selling. One was the complete inventory that we had, where obviously, much of the construction had happened. So this impact of the raw material escalation hasn't happened. And all the series of new launches that we and the industry have done, where you are right that the raw material inflation is today, like steel's now in the early 60s, which used to be in the mid 40s, per ton barely a year back. So things have actually shot through the roof. And honestly, those just have to be priced in. Priced in both in terms of what additional pricing you can pass on to the customer, and B, what additional costs you can take. But it does look that the commodity inflation does look to be here to stay, and as well as labor inflation. And so I think the industry would just have to weave those in as we move forward, really, because that's the reality. Good news: the financing costs for home buying are at a historical low. So there's a huge demand upsurge that is driving. And hence, this should hopefully eventually even out.
I just want to pick up on the point that you made as far as raw material cost inflation is concerned. That is a phenomena that we're seeing across sectors. But what about labor and wage inflation there? What is the escalation that you've seen? And you talked about being able to offset some of these increases or being able to absorb some of these increases. Do you believe that there will now need to be a certain pass-through to the consumer? What will it mean in terms of a change in pricing?
So honestly, Shireen, pricing by itself of the finished products of at least the credible developers has seen buoyancy. It is clear. We ourselves launched our independent floors in Gurgaon in I think November of last year at a price point of about 11,000 rupees a square foot. Our current additions have been launched at almost 16,000 rupees a square foot, and the pace of demand absorption continues to be as strong. So clearly, pricing is one aspect. B, I think since most of these are now happening on new launches, the commodity inflation, I mean, in that sense, you just price the current commodity prices in. We have begun a pretty scientific system of tracking potential contingencies. We are building contingencies in all our budgets now. We are tracking on a quarterly basis inflation accrued and inflation that could accrue going forward. So I mean, obviously, a lot of the inflation tracking mechanisms have become far more sophisticated, if you will. But really, I mean, it's a good old-fashioned. It's a combination of two things. How much margin can you absorb yourself, and how much additional cost can you absorb yourself, and how much additional costs can you sort of pass on by way of price escalations to the customers. And so far, clearly, the demand buoyancy is ensuring that that prices are recovering and recovering well.
Okay, so it's not impacting pricing just yet, and pricing continues to hold strong. But, you talked about various segments within the residential market, and you believe that it's a widespread recovery, not just in terms of geographies, but also across various segments. What's happening on the super luxury side, specifically as far as the NCR region is concerned, and what's the booking and the demand outlook there, as well as on the mid-level segment, which is a strategy change that you made?
Okay, so on the super luxury, the camellias, I mean, it really is having, I mean, that's in the season of its life. Last quarter, we sold 34 units, and, each unit is priced between 25 to 30 crores. So almost 900 crores plus sales came only from the camellias last quarter. I think it's a combination of obviously, I mean, now that the product is complete, I mean, people can actually go and see physically, the enormity of what they're buying in. The club's been commissioned. And I think for people who can afford that kind of price segment, I mean, clearly, I think there is a greater inclination to close the buying decisions, than continuing to sit on the fence.
We wish you the very best of luck, and thanks very much for joining us today on the CEO Sentimeter to talk about where things currently stand as far as the real estate sector is concerned, and more importantly, what the road ahead looks like. Appreciate your time.